Hello, everybody. Thanks for joining us for this webinar. I'm hoping that we have a lot of fun together. I think we're going to learn a lot. We're going to wait for people to come in. I see the number of attendees are increasing exponentially, really. So I'll give it a couple of minutes, get a chance for people to get in, and we will get started in just a few minutes. I hope everybody had a wonderful holiday season and ready for the new year. And I hope everything is going well for everybody in the new year. While people are coming in, I wanted to let you all know that there are some resources that I have included here for you. There's a couple of files that you are welcome to download. One is called Important Numbers for 2026, and it sort of looks like, let me see if I can do it this way. Most of you are familiar with this and have seen me show you numbers from something like this with some numbers and charts for from the IRS for 2025. The one there is for 2026. So you can feel free to download those or wait until you come see me in the office. And then the next file is things to consider. So it's a very helpful, interactive sort of questions to kind of help think about, all right, so what do I need to think about when it comes to the one big beautiful bill and how it might impact me? So there are some questions there. I would recommend you look through that and pass them on to any friends or family members, people who own businesses. There are some things for them to consider there as well. So yeah, feel free to share those and use those. All right, so let's get started. It's 5:01, so I'm going to begin. If you need to ask me any questions, there is a question Q&A button that you can press on and you can type a question, and I would be happy to try to address it during the presentation as it comes up. And if not, there's a chance for you to be able to sit down with me and ask at your leisure whatever question you have to ask me. So let's begin. Of course, I'm Ash. I'll be presenting tonight, and we're going to talk about navigating the new tax law and what we need to learn about the one big beautiful bill when it comes to retirement and estate planning. Now, of course, you know me, and this is my lovely family, and I've been doing this for a while. Okay, so let's keep questions general, please, because there's going to be a lot of people who are going to ask questions that are going to be try to be specific to their concern and their issue, and I don't really want to discuss personal numbers in a setting like this. Obviously, you can understand that. So feel free to reach out to me afterwards, and I'd be happy to address any of the questions that you have. You'd be able to schedule a call with me, and we'll figure out if it's necessary for us to meet in person to help you navigate through all these tax law changes. All right. This is a disclosure saying that I am not acting as anybody's accountant, and I'm not working for the IRS or the Social Security Administration or any government agency. This is for general information only. This is for educational purposes only. Please don't take anything here as instruction from me to act in a certain way. I don't know anything about you yet, so I would need to sit down with you first before you take any actions. All right. Now, there are some pretty substantial changes when it comes to the one big beautiful bill. These are 9 of the 12 of the main ones, but we're only going to talk about some that have to do with mostly what retirees care about. And so we're going to be talking about things like the tax bracket changes. We're going to talk about the increased standard deduction. We're going to talk about some additional deductions and the phase out of those. We're going to talk about SALT cap phase out. And we're going to talk about what SALT means, charitable deductions, and Trump accounts. So these are the things that are going to be primarily concerning you all with your phase of life that you are in. Trump accounts are related to grandkids. All right. Now, here's our agenda. We're going to first talk about marginal tax rates. Then we're going to discuss the one big beautiful bill and the changes. Then we're going to talk about how the different income types interact with each other, and the different income sources are going to clash with each other. We're going to talk about strategies to reduce your lifetime taxes and what the next steps ought to be. All right. In order to talk about taxes and the one big beautiful bill, we need to first understand tax brackets. So in 2026, if you're a single filer, some of you already know this, and others of you, this is news to you. There's a certain amount of money that you don't pay taxes on. That's called the standard deduction. And we're going to talk about that number here pretty soon, but this is for 2026, and it has your income. So from 0 to 12,400, if you're single, you have to pay 10% tax. Our tax system is progressive. The higher your income, the more tax you pay. Your income that's above 12,400 to under 50,400, you have to pay 12% tax, and then 22, 24, all the way up to 37. 37% is the highest amount that you can pay in taxes when it comes to federal. There's still state, there's still local, or depending on what state you live in. If you're married filing jointly, the brackets are a little different. It goes from 0 to 24,800. Then it goes from 24,800 to 100,000. That's the 12% bracket. 100,800 to 211,000. That's the 22% bracket. 403,000. That's the 24%, and it keeps going on. Anything above 768,000 is 37%. All right. Now, this is what a tax map looks like, and everybody should know where they fall in the tax map. But I want you to notice 3 green arrows that show the biggest sort of jumps from one place to the other. So from 0 to 10, that's a pretty big jump. From 12 to 22, and then from 24 to 32. So those are the big steps that you see in your taxes and what these mean. So if someone were to tell you they're in the 22% tax bracket, it doesn't mean that they've paid 22% tax on all of their income. It just means that the last dollars that they earned were taxed at 22%, or put it another way, the next dollar that they get in a raise or an extra withdrawal that they take out of their retirement account, for instance, would be taxed at 22%. But there was a portion of their income that they didn't pay any taxes on. That's called the standard deduction. Then there's another portion that they paid 10% on. Then there's another portion that they paid 12% on. And finally, the 22%. So that's how the tax brackets work. Now, the marginal tax rate is the tax bracket your last dollar falls into. So that's what we mean by saying I'm in the 22% tax bracket. That means you're in that marginal tax bracket. But it doesn't mean that's your effective tax rate. The effective tax rate is the combination of all the different tax rates together and what that total is. Okay. Now, we have to talk about capital gains and qualified dividends because they get a different tax treatment. I think this is the point where it makes sense for me to interject something that will help explain things a little bit better. So I'm going to show you a little bit of a drawing here. As far as money is concerned, okay, the government basically looks at 3 different types of money. The first type of money is money that's considered tax deferred. Okay, so what would be an example of a tax deferred account? Well, some of you are already saying it. You have an IRA, you have a 401k, 403b, and there's actually a total of 37 different varieties of these tax deferred accounts. And what's the concept of a tax deferred account? The money that you put in, you get a tax deduction on, and the money that you take out of it, that's when you have to pay the taxes. So you put the money in and it grows tax deferred and you get a deduction on the way in, but on the way out is when you have to pay the taxes. That's one kind of money. The next kind of money is what's called an after-tax account. So what would that be? That would be something like your savings or your checking, maybe your CD, a brokerage account, maybe any, I don't know, crypto that you own, gold, silver. Now, you could own gold and silver inside of an IRA, but most people own them in an after-tax account. So this is the idea where you've already paid the taxes on the income, and then you're using that money to invest it and to put it into something. So what you do is you pay taxes on the gains. So whatever it makes, you have to pay taxes on. These are foundational things we have to understand, because if I don't talk about these things first, it's going to be very confusing if we keep going forward and we don't know these things. And then the last type of money that the IRS looks at is what's called a Roth account. So a Roth IRA is where you've already paid the taxes on the way in, but the deal is that it grows tax-free. And then you'd be able to take that money back out without paying any taxes on it. Make sense? So that's where you'll see. Someone's saying everything I'm typing is delayed displaying on the screen. Okay, thanks for letting me know, John. I'm hoping that everything shows up now. If anybody can want to confirm with me that you guys can see everything that I'm typing. Do you guys see everything I've typed? Last thing I typed is a Roth IRA. I'm hoping that you guys see the Roth IRA. You see text in the first two circles. Okay, how about now? Just popped up. Okay, very good. All right, thank you for that. Good to know. So the Roth IRA is money that you don't have to pay taxes on when you take it out. So it's very powerful. Now there's other types of money, but these are the main three that we're going to talk about. And you know what's interesting about Roth IRAs is that most 401k providers, something like 90% of 401k providers have a Roth option. Most people don't know about it, okay? And only 20% of workers contribute to a Roth 401k, which is an absolute tragedy. 74% of all workers are just putting all their money in the tax-deferred bucket. So, if I may, I want to, now notice I did something on purpose. See how the tax-deferred circle is really big, the after-tax circle is a bit smaller, and the Roth IRA is the smallest? I did that on purpose because, in my experience, I've seen that to be the case. So let me do this. Now that you guys can see me in, well, actually, I lost the presentation. Hold on. Oh, there we go. Okay, so now that you guys can see me back again, all right, so let me do this. So this is a bucket called IRA. Okay? Most everybody, over 90% of people, have their money in an IRA. Most of their money is in IRA. This bucket right here. That's the majority of your money is your retirement account. This is all money that you have not paid taxes on. Now, some of you have an after-tax account, but not quite as big as your IRA. And then some of you have, get ready, you have a Roth IRA. Now, the goal here is to try to make these buckets a little bit more even. Okay, all right. So that ends the joke of the evening. I promise, folks, no more, no other jokes for the rest of the night. Okay. So the point is that we need to make sure that your different tax buckets are helping you instead of hurting you. Okay. Now, the middle bucket, okay, the cup size one, the after-tax account, that one gets things like interest, depending on how it's invested. So if it's in CDs or a savings account, you're going to get interest and you have to pay taxes on that interest. Then you have capital gain. So that's where you own a stock and the value of that stock appreciates. So you have to pay capital gains tax when you sell that stock. And you've got dividends that you also have to pay taxes on. Now, you'll understand that this says the public policy goal of different capital gain and qualified dividend brackets is to encourage investment. In other words, the government is going to give you a break on investments based off of capital gains because they want people to invest in the market. They want people to invest in the economy. They don't want people to hoard their cash and say, I'm not going to play. That's the idea. And that's why you'll see here that a couple married filing jointly, the capital gains tax bracket for 2026 from 0 to 98,900 is $0 in capital gains tax. It's only income that goes above 98,900 to all the way to 613,700 that you pay 15% capital gains tax on, and then above 613,700 you pay 20% capital gains tax. So they're encouraging investment and they're giving you a reward of lower taxes. For an individual, however, it's not as generous. So you'll see here from 0 to 49,450, it's 0. And from 50,000 almost to a little over $500,000, it's 15%. Okay. Now, notice here, I have, for a couple, you have 0 taxes to pay up until 131,100. Now, wait a minute. How come? You just said the number was 98,900. What gives? Well, what's happening is I'm adding to it the standard deduction, which is $32,200 for 2026. And so when you add that to the exemption for capital gains tax, you get a total of 131,100 before you enter the 15% tax bracket. Now, this is really important to understand because this is why whenever I help my clients with figuring out what source of income they should generate, we're playing these different buckets against each other to figure out how much should you withdraw from which account. And so you'll notice that if you just had $120,000 worth of capital gains income, where you sold an appreciated stock for $120,000 as a couple, then it would be non-taxable because it's less than the 131,100 line. Now, let's say that you took on top of the 120,000, you wanted to withdraw $32,200 from your IRA. So that $32,200 that you withdraw from your IRA would be wiped out because it would take up the entire standard deduction, and it would push that 120,000 past the 131,100 line, which means that the 21,100 would be what you have to pay a 15% capital gains tax on. Same thing would happen if you said, well, what if we take even more income, right? So the next level up, we take more income, we add another $30,000 to our $32,000 to our income, then it pushes things up even higher, and then this 27,800 of right here, you would pay some of it under 10%, some of it under 12%, and then this portion you would pay at 15% tax bracket. So that's sort of how the math works. And these are married filing jointly numbers. Okay, very good. Now let's talk about some deductions and credits. What are deductions? So a deduction is something that you deduct from your taxable income. So in 2026, the number for a couple is $32,200, and that's up from $31,500 for 2025. And a single, it's $16,100, up from $15,750. You also get the option of itemizing your deductions. That's the Schedule A. So you can either do the standard deductions or you do an itemized deduction. For most people, they will want to do the standard deduction. Very few people actually end up needing to itemize, and it's going to depend on certain things. So first off, you have mortgage interest debt up to $750,000 of acquisition debt, not including a HELOC. So if you have a regular mortgage and you just bought a house and you've got a pretty massive mortgage on it and you're paying a lot of interest, then that might make sense over the standard deduction. Then we have any charitable gifts, or that's up to 60% of your income. So if you do a lot of gifting, and we're going to talk about some strategies there a little bit later, but if we do a lot of gifting, that might come into play there. And then we have state and local property taxes up to $40,400, and that actually goes back down to $10,000 after 2028. So we only have a short while of this. And then the charitable deduction subject to a 0.5% floor. Again, something we'll talk about, but you can do a charitable deduction, and that actually, some of that deduction for charity would not be considered just for itemized deductions. You can also add it to standard deductions. Okay. Here's something a lot of people don't realize. When you turn 65, you get an additional deduction. It's $2,050 if you're single, and it's $1,650 per person if it's joint. So you get an additional deduction on top of the standard deduction whenever you become over 65. Now, there's something else too that was added because of the One Big Beautiful Bill, which is the additional senior deduction of $6,000 per person over 65. But there is a phase out. So when you turn 65, you actually get two deductions. You get the deduction that always existed, which is that $1,650 per person as a joint, or $2,050 for a single person. And then you get on top of that an additional $6,000 per person. Okay, so that $6,000 per person, however, begins to phase away as you get above $75,000 of income for a single person and $150,000 of income for a couple. And so for every dollar over, 6% of it goes away. So it takes a while before it's completely gone. And this is only going to be temporary. It's going to be from 2025 to 2028. Of course, we'll see what the political climate looks like then, and if the administration, whoever it is next, would want to keep it or not. So let's look at a single person who's over 65 with the previous tax rules and with the One Big Beautiful Bill tax rules. So you'll notice here your standard deductions before were $17,000. Now with the extra $6,000, it's at $24,150 plus, because the standard deductions have also gone up. And then there's that gray line, that thin gray line you see forming. It's once we get over $75,000. Okay. So for every dollar that's above the threshold, $1.06 is taxed at 22%. And that's where that 23.35% comes in, even though you're in the 22% bracket. And it's the same thing for a couple. So if you're at over $150,000 of income, for every dollar above the threshold, $1.12 is taxed, because of course there's 6% being withheld from one and the other spouse, because they each get $6,000. Now, there are credits that the government gives in order to incentivize behavior. So there's different types, healthcare credit, earned income credit, education, savers, child credit, and so on. All these things are ways for people to pay less taxes, that the government says, hey, I'm going to give you this break because I'm trying to get you to do something. That's going to be good for society in general. So let me give you an example for an income that, let's say, a married filing couple, and this is based on 2025 tax return, because we're gonna, all of us are gonna process taxes here pretty soon. You're starting to get the papers, the 1099s, and so on. So everybody's thinking about taxes, and I want you to think about this. So if you have a $40,000 income, that's a very modest income. Then you get the standard deduction. Then you get the deduction for being over 65. And then you contribute $2,000 to an IRA, assuming that some of that income was work income. So your income that's subject to tax is only $4,800. At 10%, that's $480. But because you contributed to an IRA, the government gives you an additional tax credit called the Savers Tax Credit for the IRA contribution, which is 50% of your contribution. So that's a $1,000 discount, which means you pay $0 in taxes. And so this is sort of a way for the government to incentivize saving. Okay, so it's very important, if you have work income in 2025, even if it's part-time, to make sure you run the numbers, and whoever does your taxes, have them run the numbers with, what if we contributed a couple of $1,000s into an IRA? Would that significantly impact our taxes? Something to think about. Okay. Now, let's talk about middle income, married filing jointly tax brackets. So we're trying to basically make sure that we stay away from these big tax brackets and reduce our taxes down to these 12 and 10 and 0 levels. But the real tax system has to do with required minimum distributions, capital gains, Social Security benefits, Medicare premiums, some Roth conversions or large withdrawals from IRAs. There's something called a 3.8% net investment income tax. There's an alternative minimum tax. There's the phase outs. So there's a lot of gotchas that you have to watch out for. You can't just assume a standard, everybody's going to pay 20% and just call it a day. You have to watch out for all of these different landmines, if you will. So let's talk about required minimum distributions. When you turn 73, and some of you who are younger, it'll be 75 for you, but when you turn 73, you have to start taking money out of your big bucket. And that's the required minimum distribution. So how does that work? Well, there's a lifetime table that is actually in the 2026 important numbers. We have all those numbers there. So if you had $500,000 at 73, you would divide that $500,000 by a factor that the IRS provides, which is 26.5, and that translates to almost $19,000 that you must take out. If you have $1 million, double it. If you have $2 million, you get the point. So here's what the table looks like. And you notice something. The distribution period actually goes lower as you get older. So when you're 90, it's 12.2 versus when you're 73, it's 26.5. So what that means is the amount of money that you have to take out every year, that the government forces you to take out every year, actually increases on a yearly basis. It doesn't decrease. It would decrease if the account itself gets smaller. But if your account stays the same, you're able to generate enough return to keep it the same, every single year the withdrawal will actually be higher as you age. Okay. Capital gains. Many people have this understanding that I only have to pay capital gains if I sell a stock. But that's not necessarily true. You could have what's called phantom gains. Um, I have had people complain to me that, hey, the market's down. A mutual fund that I've had for years has lost money, but I still have to pay taxes on it. How come? Because what happens whenever you purchase a mutual fund is that you are buying all of the stocks that mutual fund holds, and you become an owner of all of them. So if the fund manager decides, hey, we have this Apple stock that we've had since the 1980s, and it's time for us to trim some of those holdings. Well, guess what? Even though you weren't there since the 80s, even though you just got this mutual fund 2 years ago, you're still part owner of that fund. And so therefore you get a fair share of the tax consequences of that sale. So that's how you end up with capital gains tax. The other thing that can happen is rebalancing. So you own a mutual fund that's growth and income. So half of the money is invested in growth stocks, the other half is in income funds, and one does better than the other. And they're trying to maintain the balance of 50-50. So they're going to sell some stuff that have appreciated and buy some stuff that have not appreciated as much. That's where you get your rebalancing trigger. So you have to be careful when it comes to how the money is invested inside of a brokerage account. You want to make sure that you are not doing active trading, buying and selling all of the time, that the mutual fund that you have isn't doing a lot of buying and selling, and you want to make sure that you are doing it in a way that is that keeps your tax liability as low as possible. Okay. Now, many people have heard this or have asked me questions over the last 6 months about, is there taxes on Social Security or is there not? What's going on with that and so on? Well, no, there's no tax on Social Security. No, that's not true. There is still tax on Social Security. However, the government agencies that kind of research this stuff, they have determined, whether you want to believe them or not, that something like 80%, a little over 80% of Social Security recipients are not going to pay effectively any taxes on Social Security because you're getting an additional $6,000 standard deduction per person from your taxes. And so that's the reason why effectively a lot of Social Security isn't taxed. But let's figure out why that is or how that works. I'm going to say something a little shocking. If you just had Social Security as your only income, husband and wife, both are collecting Social Security, and I don't care if it's $90,000 a year of Social Security between the two of them. If that's the only income and there's no other income whatsoever, you don't owe any taxes. It's only when you add other income to your Social Security that you have to start paying taxes on it. And so there's a calculation that you do. It's called provisional income that determines how much of your Social Security is going to be taxable. So you take 50% of your Social Security plus all your other income, dividends, capital gains, even non-taxable interest, like if you had like a municipal bond or something like that, and then ordinary income from IRA withdrawal, pension, and so on. So you add all that up together, and for a single person, if it's over 25,000, then 50% of your Social Security is considered taxable. If it's over 34,000, 85% is considered taxable. For a couple, it's 32 and 44. Those are the thresholds. Now remember, that's half of your Social Security plus all other income. Okay. What does that mean in real life? Now, I'm not going to bore you with the actual calculations, but just let's assume that we're doing 2025 taxes. Okay, so this is for 2025, and we've got a couple who have $45,000 of Social Security income and $55,000 of IRA withdrawal. So their taxable Social Security ends up being $34,475. That's the math. Even though they're getting $45,000 from Social Security, $34,000 is considered taxable. Then we have the IRA income, which is fully taxable. So those two together is $89,000. Then you've got the standard deductions. Remember, this is the 2025 return, so it's $31,500. And then we've got $15,200, which is the $6,000 per person, which started in 2025. Plus, because they're over 65, they're getting that additional deduction. And so then their net taxable income is $42,775, and their total tax is $4,656. Versus the other couple who have the same income, just a different mix, $75,000 of Social Security, $25,000 of IRA. So this is where delaying Social Security makes sense because it really helps in taxes. So we've got to think about and strategize. I am not the person, most of you know me, I'm not the person who says everybody should delay Social Security. I think some people should start sooner. And I've told several people, you need to start ASAP. However, we need to make sure we run the numbers to see if it's not going to have an adverse impact on our taxes in the future. That's why the tax map is so important. So if you look at this, $75,000 of Social Security versus $25,000 of IRA, when you process all the numbers, you end up with a tax of $3. That makes a big difference. Over 20 years, that makes a big difference. Okay. So this is something I say when I teach the Social Security classes. Here's a rule of thumb that I think everybody should know. The higher Social Security is as a percentage of your overall income, the less tax you pay. Say it again. The higher Social Security is as a percentage of your overall income, the less tax you pay. Again, I'm not saying we should all delay Social Security as long as possible, but I am saying we need to be very careful about when we start Social Security, and we don't just want to look at the number that's on the statement that says, oh, it's only going to be $1,000 more if I wait. We have to look at the tax implications. Okay, very good. Now, here's something that we have to think about too. These two columns, 45,000 Social Security and 45,000 Social Security, 55,000 IRA, 50,000 IRA. The only difference between these two is the following. The sunsetting of that extra $12,000 deduction goes away. So what would happen to your taxes if you did not have that extra $12,000 deduction? Well, you would pay $6,000 in taxes versus $4,600. So your taxes would go up. And of course, if the other tax, the $3, remember the $3 one from the slide before, if you take away that extra $12,000 deduction, well, now you go from $3,000 to almost $1,800. From $3, excuse me, to $1,800 in taxes. So that $12,000 makes a big difference in the taxes people pay. Okay. We also have to know about Medicare premium surcharges. So again, I'm using a 2025 table, but if we look at 2025 income for a couple from 0 to 212,000, you're going to pay the regular Medicare Part B cost. You're not going to pay any more for Medicare Part B. If, however, your income is higher than $212,000, you have to start paying more for Medicare. So another $27 more. And then it keeps going up from there. So the more the higher your income goes, the more you end up paying for Medicare. So you have to be careful not to increase your income too much. And not just Medicare Part B, but also Medicare Part D as well, which is your prescription plan. The other thing you should know is the impact happens 2 years later. So this is what people paid in 2025 based on the income in 2023. So for this year, for 2026, what you will pay for Medicare will depend on your income in 2024. Now, some of you might say, well, wait a minute, in 2024, I was working and my wife and I were making $300,000 a year. Well, we're both retired now. Right. So you might get a letter from Medicare saying you owe more money. However, you have the right to petition and say, look, don't use my income from 2 years ago. Use my income now because I had a life event. I retired. So you're able to do that. So please, whoever, if you're getting a letter from Medicare, Social Security saying you have to pay more for Medicare and you've recently retired, make sure you let me know so I can help you not overpay for Medicare. If, on the other hand, 2 years ago you sold a bunch of appreciated stocks, did a whole bunch of Roth conversions that pushed you up into these higher dollar amounts, or sold a vacation home or something like a rental property, that's not a life event. There's nothing we can do about that. That is what you have to pay. Now, when your income reverts back the following year to a lower amount, you go back down to paying what everybody else pays for Medicare. You're not stuck there. That's only for that year. Okay, good. Now, something else we need to be cognizant of is that whenever our adjusted gross income goes above certain thresholds, then we end up having to pay potentially an additional 3.8% net investment income tax. So again, we have to be careful because these are things that are still in the tax bill. They have not gone away because of the one big beautiful bill. So keep that in mind before you increase your income. There's also something called the alternative minimum tax. I'm not going to spend too much time on it because only 0.1% of taxpayers are generally impacted, and it's for households that are between $200,000 to $500,000 in taxes. I don't think most people will be impacted by the alternative minimum tax, but it's a flat tax rate. Sort of, if your income just goes up too high, they just, instead of putting you in the different brackets, you just pay a flat tax rate. So it's a pretty big bite. You want to make sure that you are careful not to get yourself into an alternative minimum tax situation. Okay, so the effective marginal tax rate, that's a very important tax consideration because we're trying to figure out how much will we have to pay the IRS. Okay. So notice the different brackets. We talked about this earlier, and the three green arrows with the biggest jumps from 0 to 10, from 12 to 22, and from 24 to 32%. So one thing that I like to talk about, we're going to switch gears and we're going to talk about this now, is strategizing how to minimize our taxes over our lifetime. Okay, so if we go back to our largest bucket, the IRA bucket, okay, you might be, 65 years old today, and you might think, okay, I'm blessed. I have what I have. I've worked hard. I've amassed what I have, and so on. But if you're 65-year-old today, you may not need to take anything out of that account until you're 75. The government's not going to force you to take anything out of that account until you're 75. But when you turn 75, they're going to say it's time for you to take a required minimum distribution. But then you have to think about where you are right now in the tax bracket and where that extra income they force you to take out will push you. And then, of course, I don't like to talk about this because I don't believe in fear-mongering, but we have to think about what's the possibility of tax rates, given the amount of debt that we're in, what's the possibility of tax rates being higher? I don't like to say they're definitely going up. I want to do my math with the assumption that the tax rates stay level. And if they go up, then that makes my math look even better, right? So there's no need to get into that speculation of when tax rates are going to go up. But the point is that even if tax rates stay the same, we don't want you to be in a position where you're in the 12% bracket and you're very comfortable there, and all of a sudden you're forced to be pushed up to the 22% bracket. And by the time you're 75, it's really difficult to do much about it. So here's married filing jointly, long-term gain and dividends for 2025. Remember again that, or actually, it's the first 131,500 for 2026, that you don't have to pay any capital gains tax. Then it's 15%. Then it moves up to 20. Most people are going to be between 0 and 15%. But this is where it's very strategic to think about which buckets do I take income from. So it's very common. We just had a meeting today where the couple want to plan for a cruise and they want to take $20,000 out. And so it's a matter of doing a calculation. Do we take this $20,000 from our IRA bucket, or do we take it from our after-tax bucket? And what is the tax implication going to be for both? Very important that you run those numbers so that instead of paying 22% tax on that $20,000 cruise, you're only paying 15% or maybe even 0% tax on that cruise. Okay. So let's look at John and Jane. Okay. John and Jane are both over 65, and they both worked really good careers. They have over $90,000 of combined Social Security income. They both worked past their full retirement age, so they've got pretty large Social Security checks. Plus, they have $30,000 of capital gains and $50,000 of IRA withdrawals. So that's $170,000 of income. Their tax liability on that is about almost $11,000. This is based on 2025 numbers, by the way, which is an effective rate of 6.34%. So that's not too bad. That's a pretty decent amount of taxes given the amount of income, right? Okay. So how did we end up there? Well, we have to look at their adjusted gross income, which ends up being $154,850, because they had deductions and exemptions of $46,000. Their taxable Social Security was $74,000, and then a portion of their capital gains was taxed at 0%, and then 12,000 of their capital gains was taxed at 15%. So when you add the capital gains to the ordinary income, that's when you end up with the almost $11,000 worth of taxes. Okay. Now, I want you to notice something, though. Notice how even there's a gray area here, and it starts at 18.5%, then 22, then it peaks at 49.95 and 55.94. Now, how on earth is that possible that you can have a tax rate of 55.94%? Let me show you. What if they decided, you know what, we want to take an additional $1,000 of an IRA withdrawal? Okay, so you're going to pay some tax on that $1,000 at the 12%. But hold on, that's going to trigger a whole bunch of other taxes on top of that. So that's going to make an additional $850 of your Social Security taxable. That's another $102. That's going to make an additional $1,850 of capital gains to be taxed at 15% instead of 0. So that's $277. That's going to cause a $222 phase out of the senior deduction. That's another $26.64, which will then push out another $222 from capital gains into the 15% bracket, which is $33. So all that together, that extra $1,000 that you took out, cost you $559.44 in taxes, which is why sometimes it actually makes sense to take a larger chunk out than a smaller chunk, okay? Because the idea is that, well, if I only take $10,000 out, I would have had to pay more taxes on Social Security, more tax on capital gain, more tax on the phase out of the $6,000 deduction. I would have all these cascading impacts that would happen. But if I take $20,000 out, I've already hit all those impacts, so the other $10,000 is only being taxed at the normal tax rate. Whereas if I just did $10,000 this year and another $10,000 next year, I'm going to have the same repeat of the previous year. Make sense? So therefore, it's best to just take a larger withdrawal and call it a day and not take anything the next year. Okay. Now, some of you might say, okay, but I mean, let's get serious. I mean, you know, most people don't have $90,000 Social Security incomes. Okay, fine. Same thing applies to the $60,000 Social Security amount. You'll notice here it goes to 22.2, and then there's a trough of 12%, then back up to 27%. And so it's the same thing that's happening. At some point, we've paid all the taxes we're going to pay, and then it takes a while for it to kick in again with the loss of the phase out of capital gains tax, the phase out of the $6,000 deduction, and so on and so forth. So that's something you have to be careful of and cognizant of when it comes to which account you take income from. Very good. Now, going back to John and Jane, if you remember, $90,000 of Social Security, $30,000 of net long-term capital gains, $50,000 IRA withdrawal. They're both over 65. That's $170,000 of income, almost $11,000 of taxes. Now, let's just say that it's only Jane left. John's not around anymore. So what will happen? Well, let's assume that the Social Security, gets cut back. So let's assume John was collecting a little bit lower of the Social Security. So Jane keeps her $48,000 of Social Security. She still has her $30,000 capital gain tax and $50,000 IRA withdrawal. So the only difference is his Social Security stopped. Everything else stayed the same. Now notice something. Our income is $128,000. But look at our taxes. It's $15,822 now. So it's a much higher tax bite on a single person than it is on a couple. And this is why trying to optimize taxes while you are together is so powerful, because it can help set things up for the surviving spouse, because at some point it's going to be one of us left. Set things up for that surviving spouse to have the income that they need without having to overpay in taxes. So what's happening that's causing that extra tax? Okay. So the big issue is that before, when they were together, some of the capital gains was not taxed. Now, all of their capital gains is taxed at 15%. The other issue is some of their Social Security wasn't taxed, but now only less than $8,000 of her Social Security isn't taxed. So all of that, and of course, you also have not to throw in the phase out too. That goes away as well, because her income is above now that she's single, she can only have $75,000 of income, but her income is $120,800. So, and she's paying more for Medicare Part B and Medicare Part D that she didn't have to before, because they were under the threshold as a couple. But now that it's just her, a third thing that's happening is she's having to pay more for Medicare Part B and Medicare Part D. So I just, trying to highlight there are so many impacts that happen to a surviving spouse that you just don't think about when we're together as a couple. Okay. There's also something called the state and local tax cap. So that increased from 10,000 all the way to 40,000 in 2025, and then actually in 2026 it's 40,400 in 2026. Now that's going to have a phase out of its own when you're above $500,000 of adjusted gross income, down to 10,000. Now that is slated to grow at 1% per year until it reverts back down to $10,000 in 2030. So it's not going to last forever. Most of you who live in the state of Pennsylvania are probably not going to be able to benefit from this. This would apply to property taxes. So if you have a pretty big house with very, very high property taxes, that would count as something that could be deducted. You'd have to itemize, number one. Number two, you could use it for state and local tax. So if you are working still and you've got a pretty high income, perhaps that could apply. But the other thing that could come into play is if you're doing a pretty massive renovation. Some of you I know are doing additions. Some of you are doing large renovations and so on. And the sales tax that you pay for those large renovations can be applied to this. So if you're doing a large renovation, make sure that you talk with me or an accountant or somebody about, hey, maybe we should keep those sales tax receipts so that we can see if that makes sense for us. Okay, especially in the next 4 years at least. Now, charitable deductions. Here's something else that's new with the One Big Beautiful Bill. There's a 0.5% threshold for itemizers. So if you're going to itemize and you've given $5,000 in charitable giving, then the first 0.5%, so $500, would not be deductible, and then the other $4,500 would count as a deduction. Okay. But then there's a $1,000 for a single, $2,000 for a couple cap for non-itemizers. In other words, if you're going to take the standard deduction, you can have a charge of or a deduction up to $2,000 for even if you don't itemize. So that could be something that's pretty important for those of you who are charitably inclined. Trump accounts are interesting. This is more for grandkids. Now, I will preface this by saying, I still think that a 529 plan is far more superior than a Trump account. So what happens is any child who's born from 2025 to 2028 will get $1,000 government credit that's going to be added to an account for them that's going to be invested in the stock market, in a U.S. stock index, and they can't touch it until they're 18, and then when they're 18 they can withdraw it or put it in an IRA, and you can contribute as a grandparent or a parent, or anybody can contribute, I think it's $5,000 per year into that Trump account. If you're inclined to help out your grandkids and you want to give money and so on, I still think a 529 has more advantage simply because the money would grow tax-free if it's used for education. You can use it for education. Now, 529s can be used for education for school stuff even before college nowadays. So there's a little more flexibility with 529 plans here. You just can't touch it until they're 18 at all. So yeah, I think a 529 is a better use of any dollars that you want to give towards grandkids. Okay. Now, what are the tools that we can use to control and mitigate taxes? We can try to diversify among the different account types. So IRAs, Roths, and accounts that we haven't, we've already paid taxes on. We can try to use tax-deferred products whenever appropriate, like a 401k or 403b, but we need to be careful not to go crazy with them. We don't want to end up with that big, massive bucket, remember? We have to be careful about where we take our withdrawals from. And then we have to think about what kind of assets should be held in what account type. So I want to go back to the drawing board, and I want to talk about let's talk about John and Jane again. So we have John and Jane, and they're both 60. Okay. So John and Jane, they're both 60 years old, and they have done a great job of saving, and they have $500,000 in their IRA. Okay, so they've saved up $500,000 in their IRA. I'm talking slowly on purpose to give a chance for the software to update the numbers so that you guys can follow along. Now, we tell them, you should consider doing Roth conversions with this $500,000. And then they say, yeah, but it's only $500,000. What impact is that going to make? Nah, it's not worth it. Here's the problem. Let's just say that they average a pretty generous 6% return. Whoops. So they get 6% return per year. Now remember, when they turn 75, they have to take a required minimum distribution. Okay, so when they're 75, they have to take my text is here, but it's cut off by the word whiteboard. Interesting. Okay, they have to take a required minimum distribution at 75. Now, by the time they are, let's just say, 90 years old, by the time they're 90 years old, I've done the math on this. They're going to have taken, if they keep getting 6% every year, they're going to have withdrawn 1.6 million in required minimum distributions. That's how much money they would have had to take from a required minimum distribution. And when they pass on, their children will have about 1.298 million left over. Now think about the amount of taxes that they would have had to pay on that $1.65 million on the required minimum distribution. Okay? Now, because they came to talk to me, because I helped them see with the tax map, the tax implications, we were able to tell them, you're in the 12% bracket and you have $25,000 left inside of your 12% bracket. So how about we take $25,000 out every single year? Okay? And what we do is we take 22,000 that goes into a Roth IRA, and the $3,000, 12%, $3,000 goes to the IRS. And we do that every single year until they're 74 years old, because when they're 75, the required minimum distribution begins. Okay? So by doing that, when it's all said and done, they would have in a Roth IRA $1.14 million. And in their traditional IRA, because we're not going to try to go fully converting all of their money in the traditional IRA as well, because we don't need to. And the reason why we don't need to are because of things such as qualified charitable deductions. So what's a qualified charitable deduction? It's when you turn 70 and a half. Okay, now why 70 and a half? Because back in the day, the required minimum distribution was 70 and a half. And over time, they raised the required minimum distribution age start to 72, then 73, and now 75. But they left the QCD part at 70 and a half still. So that's why it's 70 and a half. But starting at 70 and a half, you can do charitable giving out of your IRA. The government allows you to give up to $100,000 per year without any tax consequences. So it's effectively a way of spending down your IRA money without paying taxes on it. And it would satisfy a portion of your required minimum distribution. So let's say your required minimum distribution is $18,000 and you give out of your IRA to charity, church, ministry, nonprofit, food bank, whatever, $20,000, then you've satisfied your $18,000 required minimum distribution and you withdrew that entire $20,000 without any taxes. Make sense? So that's the benefit of a qualified charitable distribution. Okay. Now, the IRA, the leftover portion of the IRA would still be, let's see, 607 $902,000, and the required minimum distribution taxes that you would have, required minimum distribution amount that you would have had to take out. And remember, many of this you may not have had to pay any taxes on if you do a QCD, is $693,989. So if that's something that interests you, please make sure that you talk to me so that we can help put you in a much better position when it comes to your retirement, because we want to make sure that money stays inside the family and doesn't go to the IRS. Outside of QCDs, there's other things that can be done in order to mitigate taxes. So another one is a charitable remainder trust. Okay, so this is for people who own businesses. You sell a business, you can put the proceeds of the business in a particular trust where the remainder of it, the last 20%, goes to charity, and it's got a favorable tax treatment, and you and your family are able to generate income from that trust with a much more favorable tax consequences. That's a great strategy. There's another scenario where this comes into play for people who have very large required minimum distributions, and they're already in that phase of life where, okay, I'm already 76. What do I do? And it's called an ILIT. An ILIT. So that is an irrevocable life insurance trust, is what it's called. And so what you do there is you take a portion of your required minimum distribution, you buy life insurance with it that's within a trust so that it keeps it away from your own assets so that nobody or nothing else can claim it as yours. And then you can fund that life insurance with the required minimum distribution. And the idea is that your children get this money tax-free, and it would not be subject to inheritance tax, even Pennsylvania inheritance tax, because in the state of Pennsylvania, everything you own is going to be taxed at 4.5% if it goes to your children. The only exception is life insurance, and you want to get the right kind of life insurance, not the stuff that you see on TV. That's not the kind you want. You want the kind that is second to die, which is for on both of your lives. So when one spouse passes, the other one still has the life insurance. You still have to keep paying for it, and it doesn't pay out until both are gone. And the idea there is to pass on money to the next generation with the least amount of cost and the greatest amount of impact, and avoiding taxes as well, perfectly legally. There's a lot more I can say, but we're getting past the hour, and I don't know if some of you might have any questions. So feel free, please, to ask me questions. I've got one last thing while you guys are thinking of any questions you might have. This is Judge Leland Hand. He's a very famous judge back from the 30s. And he's famous for saying this: anyone may so arrange his affairs that his taxes shall be as low as possible. He's not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. So I know some of us like the idea of, well, yeah, I want nice roads, I want good parks, I want all the wonderful benefits of living in this great country, and we have to pay our fair share, but we are not under any obligation to pay more than our fair share. So use all this information to your benefit, and if you want to sit down and talk with me and figure out your own tax map and find out if these Roth conversion strategies make sense for you, schedule a call with me. I'd be happy to discuss for 15 minutes to see if there's anything I can do to add value. And then from then we'll decide and we'll meet together. I have it in I think it should be in your chat, or you can call our office. There's the phone number to call. You can use your phone right now and do a QR code on your phone to take you to the link to set up the phone call. Well, I hope this was helpful for you guys. I hope you got a lot out of it. It's always fun to talk about these things. I can talk about these things for hours. I get really excited by them. I hope it was fun for you, and I look forward to seeing you guys very, very soon. Have a blessed day and have a happy and healthy 2026. Okay, let's see if there are any questions. Okay, yep, you guys are all welcome. Oh, I get a lot of thank yous. Thank you very much. I appreciate it. Thanks for all coming. Let's see. I'll give it a couple more minutes, see if there are any questions anybody has. All right, very good. Well, thank you everyone for coming again. I look forward to speaking with you soon, and wish you all a great night.